Hey everyone, in this video I've got one growth stock that's down 78% that I think you might regret not buying on the dip. So before I reveal what that growth stock is, I'm going to go over the financial metrics that has me excited about this growth stock, and then at the end of the video I'll reveal what that growth stock is. So let's get right into it, starting with revenue here. And you can see this company's revenue has grown very nicely over the last 5 years. It's experienced a bit of a dip in the recent couple of quarters, and that might persist given the business's characteristics, given that it benefits from consumers shopping online, which is likely to remain constrained as people are spending more money away from home in recent quarters. But longer term, I think the company will benefit as consumer behavior normalizes. Another reason I like this growth stock is because of very strong cash flows. What I have here is a chart of its cash flow from operations. I think it looks more informative if I bring it back down to 5 years, and you can see how the cash flow from operations has stayed above and close to 1.5 billion and dipped a little bit to 1.2 billion dollars in recent quarters, but a very strong cash flow generating business. And much of the work, much of the investment to build out this business was done in previous decades. So now the company is benefiting from all of the hard work it laid down in previous decades to build out its network, to build out its active accounts, to build out both sides of the equation in its business, because this business benefits not only from the buyer side, but it also benefits from the seller side. So it spent decades building out both sides of the business, and now it's reaping those benefits. And I like that. I like where it's come. I like it's getting a strong return on that investment. So another reason why I like this growth stock and what I have here showing for you is its operating profit margin over a trailing 12-month period, and I have this going back all the way to 2015. And what you could see is an operating profit margin consistently above double digits, in fact above 13.5%, above 14%, and reaching as high as 19% in 2018. And I always like to say an operating profit margin in the double digits is good. And if you approach 20%, that's very good. If you approach 30%, that's starting to be excellent. And if you go above 40%, now you're in rarefied territory. Relatively fewer companies generate operating profit margins above 40%, 50, and then above 60%. There's only three companies out of the more than 100 that I follow that have an operating profit margin above 60%. So that's just the scales where you can go, and above 10% double digits is solid operating profit margin, especially if the company is also growing revenue simultaneously. Another reason why I really like this growth stock, and I think you might regret not buying it, is because of the relatively cheap valuation. You're getting this stock at a forward price to earnings ratio of 11.77. That's the cheapest this stock has been going all the way back to January of 2022. Around January of 2022, this stock was trading at a forward PE of 40. So you're getting it at nearly one-fourth the valuation it was trading for around January of 2022. So you're getting this company, which is growing revenue nicely, generating very strong cash flow from operations, has spent decades building out its network, and you're able to buy it at a relatively cheap valuation, arguably the cheapest this stock has ever been. What is the stock? It's PayPal. PayPal is the stock I'm talking about here, and I think investors might regret not buying it on this dip here. So there you have it. That's all I've got for this video. I hope you've enjoyed it. Thank you so much for watching. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.